The similarities between the mindset required for professional elite sports and the mindset required for trading is just so similar. It blew me away when I started working with traders and saw that, just how aligned they were. And then it really is the challenge is, how do you perform under pressure? So how can you stick to your plan when you've had 3 losing trades in a row? How do you make sure that you don't suddenly start trading based on the P&L and trying to recover those losses rather than just resetting to neutral and treating the next trade as a completely blank slate? How do you detach emotionally from losses so that they don't start affecting you the following day? It's all of those small but really important ways of you taking control of your mindset and your emotions. If you can become skilled in that, then that really is the secret to success.
If I have 3 bad trades in a row or 4 bad trades in a row, then I could tell I'm losing a little bit of confidence, which is going to make my performance the next day even worse. Right?
I mean, it's natural, like, of course, but you want to have techniques in place to maintain that confidence. So sometimes people think that confidence is water in a glass, it drains and there's nothing you can do about it. But actually, if you start using very practical techniques, even if that happens, so it's kind of natural that your confidence would be dented. But if you use these techniques then, and they can be really simple, straightforward things, then you can actually work on boosting your confidence in the moment so that you can maintain that level of performance. So it's like you're constantly making small adjustments and using practical techniques to stay on top of all of that. Same with motivation. If someone has a few really bad weeks of trading, then their motivation can plummet and then they slack off maybe on doing their daily review, or they're not doing as detailed prep in the pre-market. So motivation is also kind of a variable that you can actually work on to keep that topped up as well. So I think it's about really understanding that all of this is within your control. Definitely that need to be right is something that shows up so often in traders. Also, what's really interesting is that if people have come to trading from a different profession, so for example, sales or the military, where you have to be right. I've worked with a lot of people who were in the military where you have to be right or there's pretty catastrophic consequences. People can die. And so they were taught through a military career to try and strive for perfection, to never allow mistakes, never be wrong. And then they take that mindset to trading, and actually it doesn't serve you in trading. It's a completely different requirement when you're trading.
So that's interesting, because we've interviewed some very high-level trading professionals in our shows that have verifiable track records, and they'll be the first to admit, I have a lot of losing trades.
You don't have to be perfect in order to be profitable. You just have to follow your trading plan. When people get stuck in that assumption that I have to be perfect, it always has to be green, you have to end the day green, that's something that will derail your trading. It actually increases indiscipline. So a good analogy is like a casino. The casino doesn't freak out when people are winning on the slot machines because their entire strategy allows for some losses, but they know that overall they're going to be profitable. I think the traders who are most successful understand that. They're able to accept it. I mean, it still hurts. Nobody likes a loss. I think they can understand that that is actually what's required. Like, that's part of the job description. So it's not necessarily one loss that's going to derail your whole trading account. It's the actions that you take after that loss. The skill is actually to become a ninja in bouncing back and recovering from losses rather than avoiding them in the first place.
That totally makes sense. And by the way, when I go into a casino, the casino managers are smiling. They're happy I'm there.
Always.
No, but there's a fine line between being reactive and being predictive, right? There's a line between there that sometimes gets a little bit foggy.
Well, here's the thing. When I started my career on the floor, I was guilty of taking education that didn't matter, cost good money, that was irrelevant, but I didn't know that. And so now people have all this information with the internet at their fingertips. And so there is a lot of, flashing lights to attract you that this is important or that's important. Yeah. It's got to be some things that are like, why didn't I think of that? Or that clicks, that's indisputable. Like, here's what's not disputed. It takes more buyers than sellers for the price of anything to go up. So you've got to start thinking, where am I going to get tools that help create probabilities that predict when the buying is going to come in? The example is a 2,000 lot buy order. All right, so we can't get that. We're not going to have that little bird that says, hey, 2,000 buyers are coming in. But if you put yourself in a position to kind of follow the herd from a helicopter, and the herd are the longs and shorts, right? And when you see that herd get to an edge of a cliff, that's when the market might be getting too short. What does that mean? Well, too many shorts, too many buyers that have to come in. Now you start to predict that your obligation is to put yourself in a position to say, does this tool give me the opportunity to predict more buyers than sellers? And all of a sudden you're like, yes, it does. Now it's a tool worth chasing. But if it doesn't come down and answer that simple question, then you're probably going down a rabbit hole. You've got to predict future buyers and sellers. And guess what? When people see buyers that already come in, they're not as important. because they've been filled. If I stick my hand and someone shakes it, that's a buy order getting filled by sellers, right? There's an agreement there. But the discovery process is when buyers reach out and they don't have anybody's hand to shake. And now that imbalancer, well, I want to buy it at 2, you can. How about 3? How about 4? And now that's the anatomy of a rally. So what is it you're trying to do? Find where future buyers are going to step in. And if people get stuck in a position and that position is short, and a lot of them are stuck, they're the buyers that you're trying to predict, for crying out loud. And that's the way you have to think about it.
So you guys think you like to trade the actual close of the New York Stock Exchange with whatever market you're trading? Is that the idea?
Yes.
Okay, because a lot of traders, they know they're like, I'm going to trade the open, I'm going to trade the morning, and then they kind of lose it as they go toward the end of the day. Why does that happen?
Oh man, I mean, it's funny that you say that. A lot of traders that come on our show, they call us the redemption trade, the redeemers. They'll be like, oh, I was down here, there. I think that number one, it's awesome to segment it into 1 hour. That's your hour, that's your day. The reason is there's a lot of volume. So if you are a trend trader and there's no trend that day, you'd be surprised to see when people start really kicking in and traders and institutions start trading, you can finally catch a very quick trend. So you get it over with instead of being stopped out. And, especially if there's a bunch of Fed speakers that like to ruin our days, right, guys? You'll be in a gorgeous trend and then Jerome Powell will come on and then either make the party or crush the party. You kind of get rid of that noise and you can boil it down to just you and the market together, not versus. We're all in this together.
So most of the news has been assimilated at that point, and you have market on close type of activity with people closing positions or positioning themselves for earnings or whatever. So you get that volume smile at the end of the day, and that creates price movement and opportunity.
Absolutely. I like how you say, volume. Yeah, exactly. Price smile. I love it. Yeah, so it's funny because we just say you can hit snooze, wake up, trade 3 to 4, and then you're done.
Oh, yeah. So let's take a peek at some of your charts. You have an E-mini S&P chart up on the screen right now.
Yeah, I have some levels for you guys. Talk about a nice breakout. I heard you guys discussing a possible bull flag or pennant that has been created here on ES, and we are breaking out from that. I have a nice call zone. I trade options, so you can call this just a bull zone. We have entered that around 5,900 and looking for an exit point around 5,927. That is in ES, everyone. ES is looking like a yes.
So give us, all right, so your bull zone, without giving us the secret sauce, how do you get to that bull zone?
Yes, of course. Well, we do have our Fibonacci levels that I like to take. I don't know if you guys use Fibonacci often when trading futures or stocks, but this is probably one of my favorite setups. I have my fib levels listed out, and then I have a nice confirmation fib, which is the 13% fib. That's a little trick I like to use. And once you start busting through that, and you could see we busted through the point of control on our volume profile. We busted through that fib zone. You're busting through VWAP. I mean, the path of least resistance is to the upside, ladies and gentlemen. You can't fight it.
So when you say that 13%, all right, so let's
talk about it.
I've adopted harmonics for my fib. So that's 12.5, 25, 37.5, like a keyboard, a piano keyboard. You're throwing in a 13%, which is close to my 12.5%. And you're looking at that as a breakout to the upside.
Yes.
Okay.
Yeah, a release.
And is that the Vaz fib?
That's the Vaz fib, baby.
You'll hear about it on your videos.
Yes, you'll hear about a lot of my videos. I mean, especially as a volume profile trader, I'm sure some of you in chat use it as well. You have your valleys and your peaks, and you're trying to break over those resistance points, target those nodes. We can get into that in just a little bit. But then once you start really busting out, I mean, it could be no man's land, especially if you were at new highs. What samples can you take from there? So that's what I really start integrating Fibonacci for that confirmation and to give us those extensions. It's extremely helpful, and it almost seems too good to be true. But hey, as long as it works, I use it.
In the orange, then we've got the price of gold. Now, the primary driver of gold has always been the combination of real rates and inflation expectations. How to think about this? If the Federal Reserve sets policy at too loose a stance, okay, so real rates are not high enough, effectively, the market will then push inflation expectations up. As a result, market participants will want to own gold, okay, because it's a hedge against higher inflation expectations. And obviously, the opposite is true. If the Fed sets interest rate or real rates too high, so they push rates far too high that it actually brings inflation down below their 2% target, we then start to see negative real rates. And as a result, gold sells off. So that's the construct of what drives gold. But it's not just the absolute level of real rates. Is that absolute level capable of controlling inflation expectations? And that's the key to gold, because if you just looked at gold versus inflation expectations, you would see that over the course of the years, we've had really high inflation expectations, yet gold hasn't rallied. Okay. So it's very, very important that it's all about the medium term. Where is that inflation going to be in the medium term? And ultimately, what is the Fed doing to the level of real rates to control that medium term of inflation expectations? So that's how you need to look at gold. Now, I think to study gold particularly, you need to go and look, and I've dated this back to sort of 2020, because that's when we saw COVID. The Fed obviously reacted. They cut zero bound. They did another 5 trillion of quantitative easing. So they drove these real rates all the way to negative levels. You can see we had real rates very, very low. Now, if you just looked at that absolute level, you would have said, well, why didn't gold significant rally in that time? Moreover, when we did start to see that double-digit inflation, why didn't gold significantly rally? Why were we not capable of breaking out to record highs? It was because the Fed began very quickly raising those real rates to stem any potential inflation expectations becoming embedded. Okay, so it's very, very important to understand. It's not the absolute level of inflation expectations that matter, rather, what is the level of interest rates right now, and what are the implications for inflation expectations because of that level?
On a coaching session recently, I was talking to someone who was finding they were mentally fatigued on Thursday and Friday come the end of the week in their trading, and that was impacting their trading, and they were breaking the rules because of it. And we spoke about that person was actually doing like extra research and reading and learning, like watching YouTube videos and all that throughout the week, every single day, thinking that it would help their trading, like that they would have all of this extra information and it was learning and it was helping things. But we actually figured out that that was impacting their mental energy. And so by the end of the week, what they were gaining in terms of learning and doing research was actually starting to impact them at, if you want to call it, competition time, you know, when they have to turn up and perform and execute in their trading. And so they stripped that back, and they found that they then had higher energy levels at the end of the week. So it can be something as small as that. It doesn't need to be as black and white as only taking vacation once a year or not.
And I found myself, you know, doing great Monday, Tuesday, Wednesday, even Thursday. And then by Friday, sometimes I develop this nonchalant attitude like, we'll see what happens. And I know that's either don't trade that day or don't have that attitude, but it just happens sometimes.
Yeah, and that could also happen for people at the end of the year as well. So you've got the end of the week time frame, we've got the end of the year where it goes either way. So sometimes people are like, I'll sort of let myself off the rules and see what happens. Or it goes the other way where they're trying to, on a Friday, make up for losses during the week and end the week green. And so they go harder on breaking the rules, or same at the end of the year. So one really simple thing that I would encourage people to do is rate, and we've spoken about this before, is rate your PEMs every day. So this is your physical, emotional, and mental state out of 10. And you do it every single day before you trade, win or lose, however the previous day is gone. And what that's doing is just giving you a baseline, like a check-in with yourself, a bit of self-awareness in the morning to know what state you're in. So it could be that you get to Friday and maybe mentally and emotionally, or even physically, maybe, you know, you've run out of your physical energy for the week and your scores are low. That would be an indication then that either it's a day not to trade if they were really low, or else just to be more vigilant about the possibility for breaking your rules or emotion-based trading.
So you're ranking yourself, right? And so you have to be honest with that ranking.
Yeah. And it's not about comparing between traders. It's just about having some sort of benchmark for yourself. So like for some people, it could be that a score of 5 or less, you know, on average score of the 3 means that they shouldn't trade. Whereas for someone else, it could even be 6 or less. So it's kind of about doing this over time and creating patterns of data and then understanding the link between, okay, this day that I broke my rules, this day that I move my stop, I tend to be lower on an emotional rating. So there's a link here. When I score myself lower in the morning before I've ever entered the market, I know that I have a potential heightened tendency to remove my stop loss, for example. So the power of it is really in tracking the data over time and understanding what the patterns are for you.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.